the segment of NTC has dropped.
Sure.
Customers are getting a credit history. They're actually getting savvy about understanding what even a credit history means. All of a sudden, you have 19-year-old, 20-year-old know what a civil score is.
You're surprised. Do you know those heavy-duty construction equipment, JCB equivalents? Imagine influencer marketing working as a very valuable channel for them, because there's a bunch of guys who actually demonstrate these equipments and their merits and demerits on YouTube and Instagram, and there's people who follow that and actually make decisions from there.
Our idea is that acquire customers from there immediately have, one, there is a problem that you might acquire customers but don't get them to do the first transaction. He's as good as a dead customer, but you essentially burn the entire CAC to get that customer.
Sure.
At a shop, you're getting a customer who you acquired, plus also got him to the first transaction, so he's already had his aha moment.
Yeah,
to get this product.
User engagement and retention is a crucial but least understood aspect of growing a successful business. We are here to change that. Hi, this is Ankur. Join me as I dive into conversation with the best and brightest minds in user engagement to help you navigate the why, what, and how of this subject.
Good morning from this lovely office of Kissht and Ring in Bandra Kurla complex overlooking the Mumbai airport. So I saw 5 aircrafts taking off while I was waiting for Karan here, and very interesting place, very lively and very energetic. Thanks for doing this with us, Karan. Look forward to a very, very exciting and somewhat in-depth conversation.
Glad to be here. Just extremely excited to be part of this conversation.
Awesome. Karan, maybe just, to give some little introduction about yourself and your journey to where you are today.
Sure. So I'm Karan Mehta. I'm the founder and CTO of Ring. We were erstwhile known as Kissht. We've recently rebranded to Ring now.
So rebrand.
Yes. We have been in the consumer digital lending market for about 6 years now. All these 6 years we've been doing, consumer lending where an individual customer comes to us. We very, very quickly assess their creditworthiness and give them an instant loan. The whole premise that we started with is consumer loans in India were never digital, were never 100% instantaneous. You were always at a process, paperwork, multiple documentation before you get a loan. We took that entire process, made it 100% online. We made it 100% instantaneous. So at the end of the process, the money is deposited into your bank account. There's no human in our office who's looking at your documents.
So to validate that, on my way here in the traffic jam, I installed the application, set up my Aadhaar, got into the DigiLocker, put my PAN in, and all of that, I have access to 10,000 rupees of credit limit in about 90 seconds total.
Yes.
And that the 30 seconds got added because I was probably not holding my phone while driving. Right. But good, extremely interesting user journey and extremely efficient.
Right. No, I think that's what we had to change. See, in India, the challenge is when you're doing larger ticket size loans, people are okay to wait.
Sure.
Banks are okay to process you. But there is a very, very large segment of India which wants smaller ticket size loans. They'll want loans of 10,000, 20,000, 30,000 rupees. They anyways won't be qualifying for higher loans.
Sure.
Now, for such a small loan size, banks are not interested. It's not worth their time. The unit economics don't work out for them. And these customers also won't go through a lot of hoops to get that small ticket size loan.
Sure.
So there's a very, very large gap. And this target market is about 200 to 300 million Indians. That is the target market that we are addressing. And we thought that, we have to do it on the back of incredibly robust technology. It cannot be a manual process. It has to be a digital process, end-to-end. No human ever has to interact for the customer to get a loan. That's the only reason we've been able to scale. We've scaled to a point where we are processing 35,000 loans a day, acquiring close to about 1 lakh customers a day, with bottom of the funnel being 35,000, which led to customer acquisition about 1 million customers every month.
Wow.
Yeah.
Quite insane scale, right?
Correct.
So, just to get this perspective right, I heard you talk about a little earlier in some other conversation about 60% of your customers being new to credit.
Correct.
Is that still how it is?
No, it's actually that the new to credit segment has significantly dropped in India over the last few years.
Lots of credit.
I think, lots of companies, credit companies like ours, the BNPL companies, the card companies have also started reaching out to a larger base of customers. So in a good way, the NTC profile, the segment of NTC has dropped.
Sure.
Customers are getting a credit history. They're actually getting savvy about understanding what even a credit history means. All of a sudden, you have 19-year-old, 20-year-old know what a CIBIL score is, what their CIBIL score is, what it means, have to improve it, what they shouldn't do so that their CIBIL score doesn't get impacted.
Sure.
And that's actually very, very, good positive movement in India in general. Our credit market is quite mature in the sense that very few countries across the globe have a well set up credit bureau system. Something
Correct.
like even China doesn't have a credit bureau system that works well. India has that, and that can become a very, very good factor in making credit available. Any segment of the ecosystem that wants to grow, credit becomes a raw material. So you want to pump in credit at every segment that wants to grow. In India, this young audience, the 19 to the 30-year-olds, are aspirational. They really are keen to grow both, in their careers and in their personal lives. Credit generally has a multiplying effect. It literally adds fuel to the fire when it comes to growth. That's what we are doing, setting out to do. And these customers do appreciate it. They understand, they become savvy enough to understand how credit works. One of the biggest challenges across the globe has been, it's been very difficult to convince customers that you have to pay for credit. Credit is never free, by either visibly or invisibly. When you use a credit card, and you're getting the loyalty points, someone is bearing the cost in the entire ecosystem. In the case of credit cards, the merchant is bearing, but he's going to transparently pass it back to the customer at the end of the day. In India, customers do appreciate the fact that for credit, you have to pay. So you have to pay an interest rate. If you're a riskier customer, you'll have to pay a higher interest rate. If you're a less risky customer, you should get a better deal.
Is that there yet? In terms of riskiness being put into the price bracket?
Evidently, we are actually the best examples of that. So we are in the market, we compete with companies like SBI and HDFC, where you will get a loan for 11-12%. We offer a loan as 18%.
Okay.
Customers still come to us just simply because they will not get a loan from the others. We charge them higher because for us, the cost of acquisition is higher and the riskiness of that customer is higher. So we have to kind of offset it in our interest rates. But that is working. The free market model is working.
So just to understand the segments of audience you're dealing with, there's a large bunch, which is the 200 million you spoke about, which is getting into credit, and they're getting these 10,000, 20,000 kind of loans. And then there are higher ticket sizes, and there's the interest rate play. So what would be the sweet spot or the hot segment for you when you say that the interest rate of this bracket and loan value of this bracket is the most customers that we're dealing with today?
So we get customers in the 10 to 20K range. And they are the ones who are coming in at about an interest rate of 18%.
Okay.
And these are the customers that are the sweet spot for us. These are generally, and I'm just very top level profiling them, a large chunk of these customers are young users who are either in their first, second, or third job. So one of the criteria for us is we only give out loans to people who have a steady income. Steady doesn't mean a salaried job. It could mean a self-employed carpenter or
money coming into the account somehow.
We just want to make sure that they have inflow of money into their account every month. Can come in bits and pieces throughout the month is also fine. Now, these customers are the ones who also have those immediate needs. Oh, I want to buy a mobile phone because I need 10,000 to buy a mobile phone. I'll pay it back over the next 2-3 months. I just need to buy something for my mom because I've always dreamt of buying it for my mom. Someone in my family is not keeping well, so I have an emergency medical expense.
Variety of reasons.
This 10 to 20K has been the sweet spot for us. That's also kind of the reason why we've started or rebranded to Ring and started a new way of doing credit. Which is the transactional credit piece. So one of the things that we realized in Kissht is most of the customers are taking the loan into their bank account, and then going to places and spending using Google Pay, Phone Pay, and whatnot. Right? We thought that it's a slightly roundabout manner. More importantly, customer ends up paying interest for part of the amount that stays in the bank account but doesn't end up using it. Because the money is flown out of our account, so we have to charge interest. And the other thought we had is because we want to engage with these customers in a lot more richer manner by making it more personalized for them, the history of where they spend that money will be incredibly rich for us to do that. So that's why we've actually pivoted to this model, which we call transactional credit. It's instead of giving you an outright loan that, that money is in a bank account, we will give you an equivalent or probably higher limit. With a limit, you can give them a slightly higher limit compared to a personal loan that you'd be able to give them, and tell them this limit is available for you and you can use it everywhere, online, offline, for your bill purchases. If you want an emergency need, you can withdraw that into your bank account and withdraw from an ATM as well. So we support all of this within the Ring platform. The beauty of the product now for us is that we get insights onto where the customer is using it.
I was going to ask you the simple, very basic level insight. What percentage of now is getting paid to merchants versus drawn to bank accounts now?
Right. So now I think a good 60% is being used at merchants. 40% is being drawn to sort of the remaining 40%. I think about 10 or 15% are using it for bill payment. So we have a BBPS integration within our app where the customer can pay their bills. The remaining 25 to 30% is being withdrawn as cash, where they put it into the bank account and
whatever. Then you're sort of blind to what they're doing with it. But given that this is a 10 to 20K loan, typical repayment cycles would be?
So it's a monthly cycle. So they have to, whatever they use in this month, they have to pay it at the end of the month.
And is there an option to convert to a smaller chunk in over a period?
So we are in the process of building it, but we don't have it right now. We are actually building a very, very cool set of features around what you call split by 2, split by 3 has been done by the market.
Yeah.
But we are coming up with a set of better options. We are actually letting the customer, keep rolling it for a much longer period of time. We are also giving them this option called snooze, which means that, I can't pay the bill at all this month.
Yeah.
Let me push it out by another entire month. You pay the interest difference for an extra month, but you get an extra month to pay it off. And your CIBIL score doesn't get impacted because we treat it like, just...
it's still standard.
It's still a standard loan, yes.
So do you do ask the PAN information for every single one of your...
Yeah, so even a customer, so some of our customers, the ones where we are not able to assess them in a very rich detail, even those customers, we give a credit limit of at least 800 rupees.
Okay.
So there are a large pool of customers.
Bunch.
Yes, some. And our idea is to do low and grow. Give them a small limit because we don't understand the risk. As they keep paying, keep increasing, the customer starts with a limit of 800, goes to 10,000 about 4 or 5 cycles itself. Even for the smallest customers, the KYC is 100% complete. So PAN, at least
there's
one
no
form of ID
excluding that.
You can't. We are essentially an RBI regulated NBFC.
Right.
So all of our loans are done with like the full brunt of KYC as required by RBI.
So you're an NBFC yourself, so you're not lending somebody else's money. It's your own.
Correct. So we do have a model where we do partnerships with other financiers. But for this transactional credit piece, the industry is not mature to do what you can call off-book partnerships. So all the transactional credit is currently on our books itself.
Awesome. So as far as this person's credit behavior outside of your ecosystem is concerned, would this be people who typically engaging with multiple loan givers, or would this be largely, let's say, 80% of their loan needs are being met by you because you have access to the bank information and all of that? So it's possible to find out.
So from a lending perspective, no, they don't get. So the customers that we deal with would usually have some lending obligations outside of ours, but they're very, very typical. They're either gold loans where they've kind of taken their family gold and given it to gold loan lender and gotten cash out of it, because that is one of the loans that they usually easily qualify for.
Okay.
The other ones, if at all, are usually two-wheeler loans. But outside of this, they generally don't have a lot of lending exposure outside of ours. If they do, that's usually happened either before or they end up moving to, after about 6 or 7 cycles, the customer builds a rich enough credit history with us that they do organically move to other lenders that offer them a better price and a higher limit.
And you're also enriching their CIBIL eventually. So it's helping their credit score elsewhere.
And it's actually a very, very natural outcome of the industry. One of the reasons why we are aware of the limitations of our retention and engagement is that, yes, these customers, when we serve them, then nobody else was serving them.
Right.
But as they become mature in their credit cycle, they will get serviced by larger players who can offer them.
Saying that you're bringing somewhat new people into the equation, maturing them, building them credit history, and then giving them as a ready meat to a larger play.
So our longer term goal is, if we become a large enough organization, our cost of funds will drop down to the same level as everyone else. That's a larger term play for us, and that larger term being defined as the next 3 or 4 years.
Yeah, I can imagine.
And that's essentially what we are working towards.
And are you saying that because in effect you're not able to bring the cost down below a certain level, so you can't service the guy once he has other options? That's in effect what you're saying. I also noticed you mentioned about a lot of merchants becoming your entry points with respect to how customers discover this.
Right.
And places like Chroma sell a lot of stuff on EMI, so now there are more merchants who can sell stuff on Kissht or now with paywithring.
Right.
Is that a large part of your customer acquisition play now?
Very large part. So one of the I think tentpole ideas with Ring, one being transactional credit, the other being how to acquire these customers, go to market. So not precisely Chroma, but our idea was to go to the kirana walas and the sabzi walas and the your milk vendors and your pharmacy stores. A large number of these shop owners are generally extending credit to their customers in a very, very, very
khata book kind of story.
Khata book kind of a way, right? In an informal way that at the end of the month, I'll send you the bill and you pay me. Now, what we realized is, one, with credit, the most effective way to sell credit is at the point of the transaction.
Correct.
If you do digital marketing, let the customer know that there's a loan available for you. But when the customer is in the middle of trying to buy a mobile
versus
phone,
desire,
exactly.
Right?
That was one. And secondly, we wanted to ensure that the guy who's selling our product to the customer also has a
skin in the game,
good
right?
reason to do that.
Yeah.
Now, these merchants, they have two big incentives. One is, of course, their credit is offloaded. Their cash flow becomes much easier if they're not giving out on credit. If they get paid by the customer instantly, which when the customer uses Ring, they get paid at the end of the day. So they get money the same day. their cash flow cycle becomes much easier to manage because they have to pay their vendors and their distributors and whatnot. And secondly, we give them an incentive for every customer they acquire for us.
Okay.
So all of a sudden, these merchants have become very, very vocal salespersons for us.
But you're talking about the milkman, the veggie guy, and the this guy. So the ticket sizes that these guys do business on, is this a per transaction kind of?
No, so they earn for every customer they bring new to our platform. And on a per transaction basis, they actually don't make anything. Although we have incentive schemes that if 10 ring transactions happen at your shop, we'll pay you 50 rupees, 40 rupees, 35 rupees.
So it's kind of like how the Google Pay and whatever kind of QR codes. There's also a pay with ring system here, and people who are coming in, they can do this, and they will be probably educated by the shop owner to say that you can actually install this app, get credit, and do this over there. But that's my question. You mentioned earlier about 20 to 30,000 rupee being the typical ticket sizes. But with this route, when you're acquiring customers, it's a very different kind of audience in some sense.
Yes. So what we're actually doing is we're acquiring customers from there. They will start at a limit of 800, 1600, 3000, 4000. But these same customers within 2 or 3 cycles upgrade to 10 or 20,000. Our idea is that acquire customers from there. Immediately have, there is a problem that you might acquire customers but don't get them to do the first transaction. He's as good as a dead customer, but you essentially burn the entire CAC to get that customer.
Sure.
At a shop, you're getting a customer who you acquired, plus also got him to do the first transaction. So he's already had his aha moment.
Yeah,
okay, this product works as promised. Now, when the customer goes back home, he kind of explores. He realizes, okay, I can use it here as well as there.
But this would need a certain level of field sales infra, and that's also a cost structure, right? After the point.
And I'll come to the CAC bit. For us, this is where we actually kind of made a breakthrough.
Right.
The CAC of this entire process is 80 rupees per transacting customer, which is
phenomenally low, right?
Anything else. And just as a reference point, in Kissht, over the last 2 years, our lowest CAC has been 400 rupees.
Correct. I remember the digital marketing space. Yeah.
And this has been a breakthrough. The only reason we've been able to acquire about, say, 35,000 customers every day, bottom of the funnel, which is 1 lakh top of the funnel, is simply because our CAC is so low. And
this is in what part of your new customer acquisition is now offline retail stores?
60% are coming from here, 40% are coming from online. But the 40% that are coming online are not on the back of performance marketing. They're coming on the back of a network effect created by this
brand visibility, and also display and whatever word of mouth. And you can't possibly attribute it 100% to that anyway.
And we've hardly done performance marketing for Ring. Which means that a large part of the 40% is coming just from a network effect, which has worked out incredibly well for us. One of the reasons why we are so buoyant or we are so excited about this product and the platform and the growth part it's been on is because this model has worked like a charm. We've done our projections. We did a pilot from September of last year until February of this year, and we were excited by the pilots. When we went to the market, we were even further blown away the way this.
Yeah, so I find this very, very interesting as well. But at the same time, 2 caveats. One is from a penetration perspective. I'm assuming you have a certain universe that you have mapped out, and you're trying to cover that in terms of now X% is now taking a payment with Ring. What does that look like right now?
So we are going geographically right now. We are in about 16 or 18 of the top cities that we plan to be. The way we've actually done it is we always had a field force for collections.
Correct.
We've actually taken
a field force for collections. Collections from the consumers.
From consumers. The one in a very colloquial term, Vasuli buys, but these are a lot more polished than
hopefully.
We are Vasuli, as these are all RBI standards compliant collections people. Now those same people, we said that you guys will have to moonlight. You guys will have to moonlight as collection people and as sales people. Find shops in
no wonder the CAC becomes low, because this is just staff there which is there already.
And that's starting point for us, and it's actually worked out. Still, we've been doing it for 9 months. We haven't stretched it. Our collections haven't dropped enough to justify for us to.
And the economics still are looking good.
Yes.
Which is what then begs the next question: why isn't somebody going to copy this? Matter of time, right?
Believe you me, when we started this, the biggest question we've had, and after the results started coming in that this model is working, we were kind of scratching our heads that, guys, we couldn't have been so prescient, right? Someone has to have been doing this at scale. But what we realized very, very quickly, at some level, Google Pay, Phone Pay, Paytm do exactly that, right? They have a large sales team that does this.
Did all that QR code chipkana.
The only difference is in payments, you don't make money.
Correct.
In credit,
which is thanks to UPI. One fine day, people stop making money on payments, right?
In credit, we make money on every transaction. The reason we are able to incentivize the merchant, the reason we are able to fund our sales team is because we actually make money on the back of these customers. We don't make money for the first 3 months. The ticket sizes are too small in the first 3 months. The amount of the revenue we make is very little. But as soon as the credit limit keeps increasing, we make more money. More importantly, the beauty of this model is within the first 2 or 3 cycles, all the bad apples get filtered out when the ticket sizes are very small.
Yeah.
So by the time we get to a ticket size of 20,000, where we're going to really make money also on a monthly basis from these customers, all the customers are actually by definition good because they've paid 3 cycles.
They've gone through that cycle yourself.
And that
this is your exclusive data because they've been transacting with you over there, Joy.
Correct.
But, so that's where the question of who's your direct competitor exactly doing what you're trying to do? Because people have, let's say, flavors and variations.
Right.
But how aggressively competitive is exact space?
In direct competitive fashion, very few of them. Nobody is doing it in the holistic manner that we are doing it.
So the offline acquisition and then the graduation towards mainstream is your unique play.
And while we are acquiring offline, we have a partnership with SBM, Yes Bank and RBL to offer cards to these customers.
Okay.
That we had issued cards way back in June, July, August. Went on a pause because of RBI guidelines, but we are restarting issuing cards this month.
Credit cards you're going to be issuing.
These are going to be co-branded
Which is what also amuses me. The credit cards have always charged 36% interest while you're doing at 18 now.
Yes.
And 18 has a, let's say, 0 interest period, or is it straight away interest?
It's straight away interest. So the
you're going to
difference between us and credit cards is credit cards don't charge you for the 45 days.
Correct.
Of the period, but beyond that, they charge you 36%.
Right.
36% has now become a good number. There are now card companies that charge all the way to 48%.
I agree. Which is, I just don't get it. It's so weird.
That's when I told you that someone in the industry, someone has to make money.
Correct.
Customers will pay for it transparently or
some fashion
with a lack of transparency. That is one way for them to make money. So coming back to the point, that ultimately what we are trying to do is, because we can make money, we have a visibility that we can scale this to pan-India without ever breaking a sweat. For us now, it's just a model of saying that, get X number of sales guys hired in this.
So it's more of an execution topic, and strategy is kind of sorted at least for some time to come.
Strategy is sorted, economics are sorted, and our kind of playbook is also sorted. We know which are the kind of merchants we want to go after, which are the merchants who end up being sticky, what are the points that the merchants really like about our product, and at some level. So one of the points I wanted to mention is the QR code we issue to these merchants doesn't work only as a ring QR code. It's a standard vanilla
QR code. Yeah.
So the merchant will accept money from Google Pay, Phone Pay.
Right.
That money hits his bank account just the way that Google Pay, Phone Pay does. In addition to that, he gets a ring, platform where a customer with a credit limit can come and pay him as well.
Right.
So the merchant is thinking, for me, it's a consolidation of 2 different products.
I don't need 5 whatevers. I can just do with this QR.
Let's assume that I was accepting 100 Google Pay payments earlier. I continue to do that just as seamlessly. And the off chance that I get 5 additional ring customers, I will get that as well.
Does it also ring that Paytm wala bell? You just got
no. We are in the process of launching a soundbox ourselves.
You're
about 3 or 4
months
months out. Yes.
Okay.
Paytm has done a very, very good job with that innovation.
But I just wonder, they'll have to either buy you out at some point if they have the balance sheet for it, because you will become massively valued yourselves. Because otherwise, how do they monetize? They have the distribution, but
I think everyone, and that's been the running joke in the industry, right? Anyone who can't figure out how to make money from their primary business is going to get to lending. And that's
which
one
is
of the
everyone
reasons,
does, right? All the B2B marketplaces are ultimately lending businesses as well.
And that's what we realized that, it's a much better space to be in the credit space and to go after payments rather than to be in the payment space and go after credit. Because credit is a very, very DNA thing. You can't do lending. You can't just wake up one day and say that, I'm going to launch a credit product.
I love that
tomorrow.
DNA wala approach, and that brings me. I understood you've done Swipe before for a small period.
Correct.
What was that about, and what were your learnings from there?
Swipe was essentially a mobile point of sale solution, Easy Tap or M-Swipe in India or Square in the US. And kind of the reason I moved back to India from the US is Square had just taken off in a big way, and it was a truly, truly problem-solving product. Me and another co-founder moved back to India to start Square, a Me Too product of Square in India. And we very quickly realized that, so we built the hardware, we built the software, built a fantastic team of engineers and product and the banking relationship people as well. We got partnership at that time with RBL Bank and Citibank. We were just about to launch the product. But at that time, we quickly scoped the market. We realized that, maybe India is not going to do so well with plastic cards in general. Distribution is difficult. Even if you get the cards to the customers, getting the point of sale machines out is going to be painful, which is precisely the problem we are trying to solve. But when we tried to speak to the people, we realized that, it's not that the point of sale hardware is a problem. The concept is difficult for them to understand. Expectation that they should have an internet connection and electricity.
This is still 2013 we're talking about.
This is 2013 we're talking about. It just was impossible. So we very presciently, me and my founder said, you know what, we were literally, the next day was the launch.
Then you decided to pull the plug.
We said that, the problem with a product like that is a long-term commitment.
Of course.
It's not a software product that you can say, oh, you know what, you're shutting shop, you're going away. If you have sold physical hardware to a bunch of merchants who paid you money, you can't just shut shop overnight and also, walk away. So we knew that if we went down that path, it's going to be a long, drawn-out path. There's not going to be an easy exit, but we pulled the plug without, sounding too excited about that. When we looked at how that market played out, it was an incredibly
good choice
smart
made,
move.
right? Yeah.
UPI came, I think UPI got announced in a big way about a year later, and that was the aha moment. We had predicted that India is going to skip the plastic, it's going to go from cash directly to 100% digital ecosystem.
Really? You thought that in 2013?
We thought that. We didn't know what shape and form.
Sure.
Nobody could have predicted kind of the hurricane or avalanche that UPI was going to be.
Yeah. And the demo moment, of course, kind of made a big spike, right? Funnily, exactly in 2013, I was part of Rocket Internet.
Okay.
And Rocket wanted to launch Square in India.
Okay.
So I was the guy doing that research on figuring out the whole model on how to play this out.
Okay.
And this was interesting. Also, the time where about 12 months later, RBI was slated to move from swipe and sign to chip and pin.
Correct.
Which means if you were to invest today in a whole lot of swipe infrastructure, it is going to become redundant in another 9 months or 10 months with the chip infrastructure. So you'll have to do another job.
Right.
And at that point, I'd spoken to all these Mossambi and the EasyTap fellows, and all of their devices readiness was all swipe.
Right.
So Rocket being Rocket, they could have acquired one of these guys and played this out, but at least again, probably not as thorough a job on the research, but at a very macro level, I figured that, dude, this market in India right now, next 12 months, not a good idea to enter. So park it. So 2 months spent on Pay 11 or maybe a quarter and met Citibank, the same bunch of people. They were also very excited because they found a new avenue to grow, right?
Right.
And we paused it. And off late, I also saw some of these e-commerce delivery fellows carry a card device from an M-Swipe or whatever. Yeah. But then I also saw a quarter later, the same guys are now coming with a QR code on their phones.
Correct.
They've all figured it out, right? Yeah. It's a Blue Dart QR code or it's a courier company QR code.
Right.
But the device is gone. So your foresight in whatever fashion it was seems to have perfectly panned out, right? Awesome. So, well, I think you're in the digital business, you're in the lending business. What's your size of the data science team?
The analytics team is about 30 people strong.
Yeah.
So we actually have 2 parts of the analytics team. One is what we call business/risk analytics.
Sure.
Which is,
that'll be the risk model scoring sorts.
And all of the business, the business models on how delinquency is playing out, how do we acquire and all of that. That is headed by this incredibly sharp colleague of mine called Neha.
Sure.
She comes with she's ex-TransUnion, ex-Lendo. Lendo was this credit decisioning company based on social media graphs. And she's built a fantastic team.
So lending decisions on social media graphs. I remember there was this company in Kenya which was doing a lot of very interesting work purely on mobile data.
Right.
And in terms of your own data set processes that you mentioned, you do read a lot of information from the phones of the people because it's quite rich.
Right.
So while somebody might worry about privacy laws, but I understood that you have extremely serious privacy setups here.
Yes.
But at the same time, the amount of richness of information that's here is very valuable. So is it something now, a very layman's guess would be, can you pretty much guess who's going to not pay up next month, right?
Statistically, yes. So statistically, just to give you a sense, what we do is our credit model spits out a number for every customer.
Right.
We've taken all of every customer, we've bracketed into 20 buckets. We call them bucket 1 to 20.
You named them something?
No.
New base, that, whatever, just
1
buckets.
to 20, and 1 being the best set of customers, 20 being the worst set of customers.
Worst from a credit score perspective.
Yes. So what our model outputs is...
Sorry, what's the split like? I mean, is this, I'm assuming it's not a percentile or whatever, 95, 90, whatever. It's a bunch of buckets.
So these are 20 buckets, each having 5% of the population.
Oh, it's population-wise split.
Exactly.
Okay, I was beginning to wonder if there'll be like a lot of guys somewhere.
No.
This is percentage, that's
our
fine.
model is a machine learning model, which is essentially doing the curve fitting on close to about 150 features. And 150 features take into input the CIBIL, the digital footprint, the behavioral, the demographic, all of it into account.
Sure.
And it spits out the number. The model number is a very, very simple number. It's called probability to default.
Correct.
The higher the number, the higher likelihood.
This will also be, let's say, changing with time, right? Because my probability to default suddenly changed 3 days ago, maybe.
It changes on many, many levels. It changes when the macro changes. So as soon as COVID hit, we had to retrain our model because all of a sudden the same customer with the same behavior
will change.
Will probably be likely to default all of a sudden, right? But we keep training the model every 2 or 3 months, irrespective. Now that just spits out a simple number, but just for ease of communication within the company, we can't talk about that number because it's a very, very clunky number to discuss. So we distribute the customers by 5% population into 20 buckets. every month the business team says that, oh, keep the 10 buckets open, 11 bucket open.
Right.
But when we keep 11 buckets open, there is a precise number that on this pool, you will see a delinquency, eventual delinquency rate of 1.8%, 1.7%.
Yeah.
It is generally accurate to the first decimal point.
Cool.
And generally accurate to the second decimal point.
And this is like the core of your IP created, right? The train model which has gone through all of this. And there's, 4 years history of delinquencies already in the system now at whatever scale and level?
At last count, we were processing, our model was being trained on about 14 million loans.
So 14 million loans.
And this is about
which
4 years
is big enough for your purpose?
Oh, significantly big enough.
Yeah.
The cutoff to train this model is as little as 150k loans. 150k loans will get you to a very, very accurate curve already.
But 150k loans for the kind of size you're talking about to even write that off is kind of okay to kind of invest in this whole setup, right?
Absolutely.
Which then makes me wonder that why are more people not as savvy with their models yet? Is it a question of choices, DNA somewhere?
It's actually, it's a DNA and a mindset.
Correct.
You need to have a buy-in at the top. One of the things, I think we've gotten right with Kissht is we have invested in technology, we've invested in product, we've invested in analytics without bounds. We never had this that, we need
the people choices also seem to be very clear, right? You come from a finance technology background yourself, and you mentioned about Neha as well. So very clearly a conceptual clarity that this is how we want to play this out.
Absolutely. And the other thing is, when you take a step back, again, one of those things that plays out in the favor of a credit or lending company, when you look at our total costs on what we spend on, the amount of money that we spend on our payment gateway integrations for just the exchange NDR is such a huge number that when you look at employee costs in the company, they're actually quite trivial. Given the massive size of loans you're doing, almost nobody in the company questions that why is your headcount so high? Because we are chasing multiple different problems. So instead of sequentializing them and doing them over a period of 1 year, we're like, okay, we'll have a large team, we'll do it over 6 months. Because we never run out of things to do anyways. There's always a backlog, which is multiple years worth of backlog. We want to get to them as fast as possible, and by getting smarter people in the room, by having a smarter set of people you can talk to, I think you do create stellar output.
Of course, always.
Creating a model at one level in retrospect is incredibly easy. At the same time, we didn't create a good model for the first 2 years until we hired Neha.
Which is what amuses me, because on one end you make it sound so simple, at the same time this doesn't seem like simple at all, right? It seems as close to rocket science as a data guy can imagine.
Absolutely. It's one of those things where I think in retrospect it looks simple. It seems like, oh, of course.
That's a hindsight bias, of course. Now you can say that.
Correct. No, now we know exactly what are the things to be done, but it's the discovery process. When you're sitting on the other side, you're thinking, oh, there's a big mountain for me to climb. I don't have the tools, I don't have the capability, I don't have the right guides to guide me up that mountain. But once you've done that, you realize, okay, do X, Y, Z, and you're there.
So that reminds me of a bit of a joke, and I would lighten this moment a little bit. When Columbus returned back after his trip, and the king or whoever threw a luncheon or dinner in his reception and said that, okay, this is great and whatever. So there was this murmur around the table that, what's such a big deal? We could have done it too, this, that, whatever. And it's a joke, so I don't know the veracity of this whole thing. But now Columbus, what he does is he picks up an egg. It's an egg, it's a normal egg with a shell. And he says, somebody, can you make it stand? Right? Just make the egg stand. And if you had an egg or held an egg, you can't make it stand. It'll just topple. So it went around the whole table. Everybody tried. Nobody could actually do it. So now, whatever. And it came back to him, and he said he just did a tup. When you do a little tup, it'll basically have a little crack, right? And it'll cave in, and then it'll stand. Oh, this was so easy. We could have done it too. Yes, you could have done it, but now you know, right? So the whole point of looking at stuff in retrospect becoming super easy is a lot of things I could say in retrospect, but it wasn't known when you were trying it out. And which is what, the choices that you made as a long-term business play, you've been very mindful in choices of your CAC, the kind of team and investments you're building towards data science practices, and the model you spoke about doesn't seem to be easy at all. So,
it's not.
And it's something that as co-founders, when you got together to decide about this business, is all clear to you that this is how we want to play this out.
Yeah, I think, data science, not very specifically, what we were very, very clear about is we wanted to build a 100% digital,
automated, seamless play.
We did not, and in all candor, we had manual underwriters for the first 2 years of our existence.
Achha.
We had people who would look at a document and say, okay, this document is good, bad, this customer can be approved, because we built the digital workflow, but it's basically the
automated. And this is what probably Neha came in and changed.
This is what Neha came in and changed. And we knew that was a problem. We knew
that was
we were
something
set for much larger scale. The model that we were working was not a scalable model at all. So we knew that that's a problem we had to solve. And the good part is we knew that, okay, the way to do it is to do it through data science, analytics, and machine learning. We just didn't know how to do it, and that's at least what we had in mind. We brought Neha in. She kind of turned everything around for us.
Awesome.
She's built a fantastic team. Analytics team are some of the smartest set of people in the office, anyways. She's done a fantastic job of even getting them on board. It's not an easy industry to attract talent.
Oh,
I think the richness of the data that we have here, fantastic leadership that Neha brings has allowed us to build that team.
Stepping back a little moment and talking about retention as a subject, where the underlying data stack, if it's not robust, if it's not well made, you cannot do a lot more on top of it. And since this has been a priority for you, I would love to dig a little deeper into your early days of journey, where you started with capturing a certain amount of data, whatever that data sources were. How does it come together in an actionable fashion? Because the moment somebody is doing a KYC, you anyway have their contact details, and your I don't know if the email is a big channel or not, but SMS and WhatsApp you have available, phone numbers are there. So what was your original thought process on how do you lay out the data stack in the early days?
So for us, and let me break it down into two parts. One is pre-automated writing, and after that,
sure.
Because once we went to automated underwriting, we actually changed almost everything about the product itself. In the pre-automated underwriting stack, the best channel to communicate with the customer was unfortunately picking up a call and calling the customer. And that was just an outcome of, at that time, WhatsApp was also...
This is 2016.
2016, 2017.
This is 2016, 17.
Yeah, correct. WhatsApp was also a slight bit of a hit or miss for a large segment of our customers. We were also at that time not necessarily app only. So we had a lot of integrations with Carrot Lanes and the Flipkarts of the world, where customer did not necessarily have our app. So push notifications were out of action.
Sure.
You also left the customer didn't have a home screen of your app where you can communicate to. So the only channels of communication for us was SMS, email, and phone calls. For a large pool of our customers, email was out.
Yeah, exactly.
They didn't read email. They probably didn't even have email addresses, or they had email addresses which they used but they never opened.
Correct.
They probably didn't even have the password to open it in many of those cases. And SMSs do end up having a lesser interaction rate. So we always, and the calls that we used to make to the customer at that point of time is, so we looked at your documents, your photo is not clear, you need to go and upload the photo again. And we want the process to get closed as fast as possible. These guys are attacked where they had to close the case in. So they would find it easiest to pick up the customer and call them and tell them XYZ. It's also easier to communicate, right?
Yeah, but it's also expensive to scale.
Super expensive, which is the reason why we knew when we saw that process, we knew that, okay, there are 10 underwriters right now. The scale at which you want to go to, these 10 will have to become 10,000. And like, okay, there is no way in hell.
Yeah.
Are we going to run a company that has 10,000 underwriters working in some, back office doing this process?
But that's what a typical large bank would have, right?
Large banks actually do much lesser loans of much higher value. That is why they love home loans, they love car loans, because they can essentially, and that's where the unit economics come in.
So the cost of doing this is more because of the underwriting element. Sure.
So that's, and which is where we've kind of carved out our niche, right? The business that we are doing, banks will not be able to do that business, or at least they've not
unless they invest super heavily, which is a DNA problem.
Correct, which is a DNA problem. Precisely. So that's where we started. When we went to the automated, everything changed. By the way, that is precisely the time where we engaged with WebEngage as well.
Awesome.
And I still remember, the time we had discussions with your team. I know there was a person called Krishnan that I interacted very closely with. That's because we were grappling with this problem and that is the time roughly where we said all of our customers will now take a loan only through our app and no other channels, no online this thing.
So you've killed your online discovery.
We've killed our online discovery. We've kind of made it almost mandatory that any customer who takes a loan from us needs to get our app. No, and I think in lending, the interesting thing is everyone is targeting a separate niche. There are many niches. You'd be surprised.
Amazing. They were talking about somebody taking a loan for a 800 rupee kurti, somebody taking a loan for a piece of cosmetic and stuff like that. I was very amazed at the kind of penetration this kind of stuff can reach. But anyhow, that's a full-fledged discussion in itself.
Just a small tidbit. When we were starting Kissht, when we were doing the landscape, in large parts of India, there are lending companies that focus only on lending for truck tires. There are companies, and these are your small lending companies. Their only business model is when you want to buy a truck tire, they will finance, because truck tires are 20,000-30,000 a piece. These truck drivers don't have the money
liquidity
to fork out. It's about 1-2.5 lakh when you want to change the whole set. So companies exist for that. There are companies that do only lending for ear implants.
And this is like all, worlds of opportunity for you guys, right?
Exactly. The whole idea is that lending is so diverse, it can be so niche driven that you would be surprised. So there is a niche for everyone.
But is this guys following those whole whatever CIBIL, secure, whatever processes?
No, I think
these are informal money lenders.
They are all slightly informal money lenders. They have their own standard practices. They have their own trust models. They know this guy I can trust because he's known to X or known to Y.
That would saturate, right? After a point from scale, so it's massively fragmented in that sense.
Massively fragmented. I think their book size is very small. They're very happy to make whatever revenue they make on that book size. And I think it's a win-win.
Like mom and pop of lending, I would probably classify that. Yes. The other bunch probably I would have interacted some bit was in 2008, 9 when I was in B school. The microfinance as a subject was massive.
Right.
So you'd give a 5,000 rupee loan and then you'd go every week to collect like 55 rupees back or something, and people would actually have to come, give attendance. That was a nightmare from an execution perspective.
Right.
Because the more you scale, the more people you'll need and the more you'll waste people's time to come back. And that all is obviously gone.
Right.
But is that even a meaningful space anymore?
So microfinance is, the MFI institutes have now all morphed into essentially slightly traditional lenders.
Right.
The MFI, the problem that you described is a problem very close to my heart. It's been one of the case studies for India, right? India pioneered that concept. The whole challenge was pumping credit into rural spaces, specifically in MFI. When you think of MFI, you think of women because that was only targeted at women. Some of the concepts of MFI were incredible, right? The whole thesis rested on the fact that because there's a social circle, everyone will have a social pressure to pay.
Yeah.
They also knew that women are much better at managing credit than men.
Yeah.
If you put,
they only put money in the woman's account, not in the man's account.
It's a very, very good starting point. I think it has matured. I think India, one of the things that is happening in India is now the blur between rural and urban is not that large. These rural people have smartphones, they have 4G, they have internet, they have access to all the information.
Yep, YouTube
they
is
have
amazing.
access to Amazon, Flipkart, Meesho,
and
the others to them.
Do you know those heavy duty construction equipment, JCB equivalents? Imagine influencer marketing working as a very valuable channel for them because there's a bunch of guys who actually demonstrate these equipments and their merits and demerits on YouTube and Instagram, and there's people who follow that and actually make decisions from there. I would have never imagined this. So rural penetration of information is amazing.
With farming, influencer marketing with farming, there is, so I am part-time, became a part-time farmer in COVID.
You did?
What do you farm? So I've been growing papayas and bananas, and so I have a ancestral farm in Umargaon, which is about 130 kilometers away from Mumbai towards
That's not bad.
Gujarat.
So it's accessible in there.
It's accessible. It's about three hours away from my house.
Very cool.
But one of the cool things I realized is the amount of high quality YouTube video channels that exist for everything on how to set up a drip, how to what is the fertilizer you have to use, how often you have to fertilize, how to identify which insect is affecting your crop depending on the leaves.
Right.
I was amazed. I'm like, okay, because it was such a high quality content produced and they had good sponsors. You could see paid promotions, right? I realized that, oh boy, this is good because it's a win-win.
It works for everyone.
Didn't have access to such a high quality material. This influencer is making money, but all credit to him. He's
making sure the whole bunch of stuff is getting penetration, right? In the markets.
And the other thing is, I did a lot of research on my own. The guy was actually giving very credible information. It was not like a charlatan or everything. Just everything was on point. I followed a lot of his instructions and I did well. India is in a different crazy
place. This guy Neeraj Chopra said, right? He learned his javelin practice by watching Olympians on YouTube. So, of course, a lot of marketing for YouTube for free for that way. But coming back, so rural markets do have a stronger education and microfinance businesses have now morphed into traditional lenders. And in your case, you talked about a topic close to your heart. So, is this an opportunity / area of conscious focus from your perspective?
Not directly. It's been a learning. Whenever I've spoken about what is it that you can bring additional with lending, the social element is one part that you always do bring. I've been very, very again candid. For me, it's essentially the business has to make money. It has to pay salaries. It has to make value for our investors. No doubt that is the primary duty of ours. If along at the same time you could have some social impact while not being a not-for-profit organization.
But very fundamentally, when I looked at that space reasonably closely, these are women who need working capital to probably either let's say buy raw material and translate it into a finished product and sell it at a 50% kind of gross margin. They rotate this on an everyday basis, which means their appetite to absorb cost of credit is quite substantial. It's just that they don't have access to any credit.
Absolutely.
So if it's a fisherman who needs a new net, he's going to make that money back in like 3 days.
Yeah, absolutely.
But he needs that money to buy that net to start with. There was this all of these, I would say, textile kind of place where people need to buy threads and cloth and raw materials and whatever. And for want of that piece of credit, they will end up not being able to take that job.
Right.
And if you're able to make this accessible, this is women self-employed, 10, 20,000 ticket sizes as well. Again,
correct.
And it's massive because it can unlock an insane amount of opportunities for these guys.
Absolutely.
So from a structural perspective, right now in your systems, this is not an audience you've gotten to, or do you see some signs now?
No, so we we do the way we've been distributing our loans, or not by design, by just the way it's played out. It's 40% is urban, which is tier 1 cities. For us, tier 1 are the top 20 or 30 cities. The next 40% of our loans go to tier 2 and tier 3 cities. The last 20% go to rural. Rural, when we looked at the profile, they very strongly overlap with this profile. They are people who are borrowing from us to get either raw material or to fix an equipment that they are going to use for their trade. This is essentially trade credit.
These have been acquired digitally, or these have been acquired offline?
100% digitally. We never go offline except for this concept of acquiring merchants.
Correct.
But we never go offline for customer acquisition directly. They are still coming to
the
Kissht
offline
app.
merchants are ultimately going to acquire customers.
So this is on the Kissht platform, which is the personal loan platform. In Ring, we are so far only on the top 16 cities yet.
You're still maintaining these two as distinct.
So yes, we
pieces.
had to, unfortunately, Kissht, not unfortunately, but I would
By
say
design.
Fortunately, Kissht has a massive brand recall for all of
Sure.
our customers.
And it's a great name to have, right? Kissht is like the default word.
Yeah. And we didn't want to overnight tell them that, oh, Kissht has become Ring, you guys are on a new platform. And there's a different form of credit now available. Although what we were offering as Kissht is a subset of Ring,
right?
But the primary focus of Ring is transactional credit with the option of withdrawing. So what we've done is we've kept, at least the consumers kept both the platforms up and running right now. Over a period of time, with the right kind of messaging, the right kind of communication, the right kind of education, we're going to be transitioning all the customers into Ring itself.
Fair enough.
At the same time, telling them that whatever product you are using in Kissht is equivalently available in Ring, but there are 3 other additional products available for you. Sure.
Which is a journey as well, because if you don't do it carefully, it can be quite a deal breaker. Okay, so back to our thought around the data stack that you're putting together when this shift happened, when you looked at WebEngage as well and started to build this underlying data setup of user profiling and event attributes. So a lot of things that come in the way. So we'd love to understand a little more about what was the thought process that went into building the original data stack.
Right.
In the new version of it.
Let me take a step back and tell you what the pieces of our data stack are, right? And there's very, very rich data. One is the hardcore demographic data that we get from KYC, very, very standard format. For us, it also comes from a very trusted source. So it's
as authentic as it can get.
As authentic as it can get. There are no gaps. There are no
100%
things that we have to bridge or assume or guess. The second set of data is all of the credit related data that we get from the bureaus. Like how's the customer's credit score, how many loans he has taken, how long has he been active, credit card user, not a credit card user, gold loan user, not a gold loan user, so on and so forth. And many
basically make each of these into user attributes and
yes.
enrich the user profile.
Correct. The third data source for us has been our digital footprint. Is the customer an user of Ola? Is a user of Uber? Is a Swiggy user? Is a Zomato user? How frequently does he travel? Does he do a lot of train travel?
Are these all, let's say, metamorphosed into some sort of a summary score, or is this all maintained as raw info?
What we are doing is, so this is what we call as we create these as features. These are also what feed into our machine learning model for this thing, but we store them as
raw data
as well, because we use them in a lot of ways.
There could be a variety of other ways.
And the third data for us is the behavioral data. How often does he open the app? When was the last time he took a loan? How often does he take a loan? Whether he pays back on time, pays back within the first 5 days of the due date, pays back within the first 20 days of the due date.
So a lot of derived data as well, right? This is the user has a few events, but that translates into a bunch of different subsequent variables.
Correct. And now with Ring, we are getting an additional layer of data, which is where does he use it? Where does he use it? What kind of purchases is he making with the credit?
Sure.
Are there a lot of small ticket transactions or a few high ticket transactions or one transaction a month that he's just doing? Is he taking the money into his bank account or using it for UPI or using it for online? All of this is the data we get. In addition to all of this, of course, we get a bunch of data from, say, an app store. Where did we acquire the customer from? We get a lot of data from Mixpanel. We are using Mixpanel's analytics and how is he navigating the app? Whether he's using English or is he using Hindi? All of that data comes in. All of this flows back to our systems. And we have many systems. We have a transactional database which holds the transactional data and the KYC data. We have a unstructured database Mongo, which is holding all the digital footprint.
Right.
And our features are going to our feature store, which stores all of these features for machine learning purposes.
From what it sounds like, it's safe to say that this is all reasonably well unified for you.
Correct.
It's the user entity across all of these systems that stitched together. You can, if you wanted to, of course, it might have quasi-legal privacy, whatever issues, but technically you have one guy's record with just about everything put together.
Absolutely. And so we have a data warehouse in Snowflake, where all of this is unified.
Sure.
We want to make sure that the data is easily accessible. By the way, just to put the privacy lens to it, the raw data flows into Snowflake, and the raw data layer is not accessible to anyone in the organization. The first level of rollup that we do in Snowflake strips every single PII data.
Identifiable information.
So all of a sudden you have a bunch of very rich data, no way to map it back to a
Can't do
customer.
anything with it.
And of course, the only very, very involved analytics people get access to in the first level of rolled up data. Most people operate at what we call the second level of rollup, where you're actually rolling them into a lot more meaningful attributes.
Much more aggregated sorts.
Correct. And that's where the richness lies. The complexity is reduced because they don't have to do any more computation. And this layer, the second layer of rollup, is what forms the basis for almost every interaction that we do with the customer. This is also the data that flows into WebEngage for us. That's the layer that we basically push to WebEngage, and that's where we decide our cohorts. That's where we decide our flows and campaigns and everything.
Got it. So unification is sorted. Now, in terms of let's say segmentation, you mentioned those 20 buckets that you had, but that's one way of looking at it. But I'm assuming you have many different ways of breaking this audience down: tier 1, tier 2, gender.
Absolutely.
So what are the most important ways in which you break this down?
So the most important way for us to break it down, the primary one, is what we call the behavior or the repeat behavior of the customer.
Okay.
We bucket customers into new customers that we very freshly acquired. They've been with us.
Is there a frequency value to this?
One loan or less.
One loan or less, okay.
Then is another part which we call early repeat. Early repeat are customers. And by the way, when I say one loan, as in the transactional credit space, this is one billing cycle.
Right.
Then we have
one loan and one repayment as well.
Or one loan active, ongoing, whatever. The first loan is where there is a very, very different set of communication, very, very different set of education, information, messaging to the customer, because this is a customer where we want.
But then you'll have the recency variation also, no? Because there will be people who will be at this like from 3 days ago, but there'll also be people who are like 3 months ago.
Absolutely. So
frequency is the first cut.
Frequency is the first cut. The way we do the first cut is we call these new customers. That's one bucket. But within new, we have many different campaigns.
So level 1, I'll come to level 2 for sure. I know there's a much more deeper play there.
The second bucket is what we call early repeat customers in their second to their fifth loan, which is where they've kind of gotten ingrained in the system, but they're still not. People will say are super active.
Sure.
And the third set of customers are the late repeat. The late repeat.
This is this term that I'd heard from somebody in the B2C space called low frequency, that if you've taken 4 orders, the probability of repeating for the fifth one is about 80%. Do you have a number like that in your situation?
So yes. In fact, we call it the R number.
The R number, okay.
Essentially, what we've seen is the first to second loan conversion, we see a drop of about 40%. Only 60% people stay back.
Correct.
Very surprisingly, second to third, third to fourth, fourth to fifth, all the way until ninth are all about 90% retention. There's no difference between second and third and seventh and eighth.
So after second, you kind of covered.
Yes. The reason for that is the biggest chasm for you to cross is the first to second.
Yeah.
Whatever experience, and which is why there is a special bucket for us called
making sure that you're doing all of that very thoroughly.
Because this is where we optimize, over-optimize, obsess, and literally go.
Fun fact, all consumer businesses, the massively is exactly where this is, the first to second. I mean, you acquire a whole bunch of them, but they don't come back, which basically means your CAC is all written off. And the whole business model falls apart because you don't have enough repeats.
Correct.
So, yeah, absolutely. So, the first to second is done. Second to third is good condition.
And third to fifth is also where we end up focusing on cross-selling them other products.
Then there is value creation of various kinds, right?
And once the customer has gone to sixth or higher, at some level, we know that this customer
is on autopilot now.
He's on autopilot now, but
he's also going to graduate from your
and we kind of have to kind of reinforcing to him that, we'll serve you better than other people will now serve you, because we know you very, very well. Sixth alone is where their rates drop drastically, where they
externally,
the rates
on your platform as well
externally drop drastically, and which is why our rates also for him drop as low as we can possibly go.
How fast are people moving from this place to that place? Is there a cohort which is moving super aggressively?
So we actually end up we even in this cohort, we still lose only 10% of customers every cycle. But
you
now
lose 10% of customers.
10% every cycle, but they are all going to some
Traditional
competitor.
credit.
And
Or
also, by the
competitor
way, if you do just a calculation, right, by the time we're looking at the 6, we're already down to about 30 or 40%
Of course,
of the
original
start.
cohort. Yeah.
And hence, we have very, very less customers to play with, but we lose them over a period of 8-9 months.
But from your own economics, I'm sure by now this is covered for you.
Yeah, so we are almost all of our CAC, all of our default losses.
80 rupee CAC any which way.
Yeah.
It doesn't matter.
No. So there is also a risk loss on the first loan, right? So on the first cohort that we acquired at that 800 rupees, we see a much higher delinquency simply because we've been very lenient in acquiring customers.
But that's so instead of this CAC you're spending here, which is fine. It's an 800 rupee exposure.
Exactly.
So I mean, half the people would probably be happy to pay that as CAC.
Exactly. So that's essentially, by the way, the model.
Yeah.
We assume, not that we experience, we assume half of them will not pay. And
but
the
that's
other half
built into your model, right?
Yeah.
From your economics perspective, you know that you're basically investing this money to just guess if he's going to play or not.
Correct.
You know, gaming people put in that money in the wallet just so that guy will, blow it away and then he'll want to play more. So that's all the addiction on the game. So now, as far as the flow of people from this 0 to 1, let's just say 1 to 2, right? That's where the biggest part of the drop is, and that's where the majority of your focus is. And after that, you have 3, 4, 5, 6, and all somewhat stable. But people are leaking to either more mature credit because they're getting a better price, or they're leaking to, let's say, a competitor.
So combination of both, quite frankly. And when we've always done the analysis is around the 6th or 7th cycle, they start leaking to more mature players
because they're getting a better deal.
Ticket size. More than a better deal, actually, the attraction for them is a higher ticket size. All of a sudden, they start becoming eligible for loans of 5 lakhs, 6 lakhs.
And your upper cap is?
Our upper cap is 2 lakhs.
You won't go beyond that. It doesn't make sense for you to take
also very rare. For all intents and purposes, our upper cap is 1 lakh.
Okay. So for this guy now, as far as his own credit appetite is concerned, and is there like a chance of recovering? Do people end up coming back after a few months, or typically do they uninstall the application? What's your point where you consider this guy is gone?
So we basically have what we call a cooling off period of 3 months. If the customer is not transacted in 3 months, we essentially put them into the dormant pool.
Okay.
Very, very few customers ever come back from that. When they do, it's generally because their credit history has gotten worse. And then again,
they're again slightly desperate for the possible loan.
So they do become dormant. We've seen customers come back even after 2 years. We have customers now coming back from 2019.
Super tiny base, I would imagine.
Super tiny base.
So the meaningful meet for you is where the 0 to 6 journey is happening. And would it make a lot of value prop for you to say that this 90 is 19, can I make it 95? How does it weigh in your priorities?
So we've not gotten there yet. Our focus right now is on making that 60 higher. Even a 5% increment in that.
That's massive because that's a compounding effect throughout the journey.
The more important factors for us are a bunch of metrics around how likely is the customer to pay automatically.
Okay.
So one of the big differences between us and other lenders is we don't have an auto debit mandate set up.
Okay.
We always require the customer to come in voluntarily himself and pay using UPI.
Just to launch the app and then go to his UPI and make a payment. Okay.
Or, many modes to pay. He can also pay from a web link that is sent to him over an SMS. Or he can just open the Paytm app and say that I have a lender called Kissht and he can pay using BBPS.
Okay.
Many ways for the customers to pay. This is all the kind of education we do to the customer in the early days, that there are many ways for you to pay. But we need to remind the customer
that... to pay in one tranche or multiple?
He usually has to pay one EMI a month. Or he has to pay one bill for Ring in a month. Now he can choose to pay in whichever he wants. He can pay 500. Let's say his total EMI is 5,000. He can pay 5,000 one shot, or he can pay 500 multiple times.
Assuming this is also going to break down into a few segments, right? Because the first transaction, the first loan that he's got, there are value buckets within that, and then there are recency buckets within that.
Absolutely.
And you mentioned the variable of was the payment automated versus what is the alternative?
No, so it has to be, the customer has to come and do a voluntary payment. We used to do auto debit very, very early on.
With nudges though.
Yes.
But you will send him reminders, SMS, whatever.
Correct.
But with those, if he's doing it versus?
No, there's no versus. We have to nudge him and he will come and pay.
Correct.
That's what.
And that's where your intensity of communication reminders, whatever, will increase depending on the vintage or age of that thing. So now, as far as the engagement with this guy is concerned, I would imagine that at the 1 to 2, we'll stay within this bracket. The payment, whether it's due and it's overdue and how overdue, is one variable.
Right.
But what else are the variables you're using to kind of decide your engagement?
Most important is what we call T-2, T-4, T-6. We
On the
bracket
due
the
date.
customers under the due date. How far away is from the due date? That is what sets the intensity.
Sure.
The other one is we have an internal risk score for the customer. That is this a customer who's very likely to pay. Where the probability of default, the 1 to 20 buckets that we were talking about, where the probability of default is very low.
Right.
So we know that this is a customer where we have to send the fewest nudges or fewest reminders, maybe 1 or 2 reminder in the right model will do the job for him.
So it would be fair to say that at this point, your communication play will break into those 20 buckets, or at least maybe groups of those 20 buckets,
yes.
and say, "Ki, this is, let's say, more frequent, more intense, more whatever. This is less so and whatever."
Absolutely.
And again, that will probably, after more days pass by, that will also come back
Absolutely. Absolutely. And what you described is exactly what happens. Is like you see the likelihood of the default, plus you see how far away from the payment or how far deep into the red zone he is.
Right.
And that's how the intensity of the messaging changes. We also have different communication as he goes later and later into his bucket. What happens is in the early days, after he's already missed this payment, our reminder to him is only that, hey, Karan, you've missed your payment. Just pay it so that, your bill gets cleared and you get to continue using your limit. Because as soon as he's past due, his limit is essentially suspended. So our messaging to him is that you're past due. And the tone of the message is, hey, it seems like you've forgotten. Here's a reminder, come back and pay, and all things.
Is that the reality? A lot of cases, what percent of people end up paying after a due date with reminders or whatever?
We have about 5 days of grace period. So if you pay within the first 5 days of the due date, no harm, no foul.
So just to understand across buckets, the behavior I'm assuming would spike on the due date and maybe a few days before and maybe a few days after.
Yes.
But is there let's say a data set which is going beyond this side or this side, and that there is value in it?
There is actually, it's a bell curve, quite frankly, so there are customers, and I think harping on your earlier example, there are customers who will take a loan in the morning, pay it back in the evening.
Be done.
They have 30 more days to pay,
right,
but they'll pay on the same day. And we investigated deeply into these customers because that's a fraud indicator. We found out that these are actually these vegetable vendors who are buying fresh produce in the morning, taking credit from us, buying fresh produce.
Perfect, right?
Selling it throughout the day, taking the money back. It's like, meko ye loan ka tension nahi chahiye.
Bijak would kill for this. Bijak as a business model does this exact same thing, right? The short-term working capital loans, because they want to have commodity transactions in the morning, repaid in the evening.
Correct.
But okay, so we have the 1 to 2 hour segment.
Very early in the cycle. T day is the peak. T day is where the intensity is the maximum, and almost all the customers want to actually pay on T day.
The most optimal way to pay.
Most optimal way to pay. Of course.
Is the grace known or not known?
The grace is not known. The way the grace works is our penalty charges start from T+1.
Right.
Technically, at least on the
agreement. We'll waive them off.
For first 5 days, we don't charge them. Not only do we not charge them, if they don't pay, we don't even penalize them by reducing their limits or increasing their interest rates. The first 5 days are truly grace. But of course, we don't communicate to them. Communicating a grace period is as good as saying that you move your payment date by 5 days. So the grace period is always not known. And also the grace period is something that we could change arbitrarily if we want to.
Right.
Because we've taken consent of the customer to do it at T+1 itself. Our first payment reminder started T-4, so we have 1 on T-4, 1 on T-2.
It's typically a monthly cycle, right? From the first bill date to the first payment date is 15 days a month, 30 days.
Yes.
And you will start reminding on the 26th day that your payment date is approaching.
Yes. Okay. And there's 1 on T-4, there's 1 on T-2, and there is a higher intensity on T throughout the day.
Sure. So there'll be multiple. I'm assuming whoever's paid exits automatically out of this whole thing, right?
That's one of the most fundamental things. One of the worst thing for us to do is
once you paid, kindly ignore if paid, which is so stupid. People still do it.
Oh yes, and it's surprisingly how many people still do it. Someone like
my phone bill still don't get it.
Yeah.
American Express still does it.
Yeah.
Damn. I met their CTO the other day. I should tell him stop. I mean, to use WebEngage like Kissht, right?
No. So that is it. It is quite surprising, and almost all of my cards still do that. Ignore if
kindly ignore if paid. It's so annoying. Yeah. But yeah, sure. So you don't do that, right? Thankfully. Thanks to WebEngage. Good.
Even a single campaign getting misfired with that, it just increases the spike on our customer.
Call center.
It's like, what the hell are you guys doing?
Exactly. Just
have you guys not received my payment? Have I been defrauded? That's the kind of.
I remember you're mentioning that the customer expectation has become this way, right? Yeah. He expects to be digitally serviced, and he expects that you know this, right? I mean, I made your payment. Why are you asking me again?
Exactly.
So, ignore with paid is a very annoying thing, at least. So now, as far as this audience intensity is concerned, the messaging is substantially spiked at a certain time window. Is there a channel play here? Does the calls ever get involved?
So yes, no, now we've started doing IVR calls,
Automated voice.
Automated voice, and in fact, there we are actually experimenting with a bunch of voice bots that are incredibly human-sounding voice bots. We are working with a company called Unifor. We are working with Google. We are working with a couple of other companies. We are actually doing a lot of pilots, but we believe that will have a different impact. Channels are all the usual suspects. I will
ignore all parallel
email,
sequential.
All parallel sequential, but after in the later cycles, the early repeat and late repeat, we actually customize for the customer. In the first bucket, we know very, very little. The only customization that goes in the first cycle is customers choose a preference of the communication language. So all of the communication is in their language of preference to the extent that we support it. So the only customization is the language preference of the customer selected. We just customize to that.
And there are how many of them now?
So we at least give the customer the option of, I think, 12.
Okay.
But we currently only support some 5 or 6. So we do a force fit that even if he's chosen Bangla, we'll still force him to.
But is that because of a technical limitation?
Yeah, because we've not technical, but operational limitation that we've not had, the right translators, all that.
Okay.
We thought we'll capture
but
that
this is also legally accepted messaging, right? Is there a regulation around whatever this is?
So there has to be a communication in English at least.
That's a legal requirement.
Yeah, and the way we do it is I kind of tell our app is originally all in English. In fact, our app is only in English. There's only this option of communication preference that we've put.
Right.
But
it's not a hard preference yet. It's a soft preference.
Channel preferences is one. Communication language preference is the other. We are also applying a filter, but not so strongly, of the ticket size, the exposure we have to that customer. The ones that are higher exposure for us are the more meaningful ones because we want to recover that.
Will you chase them more? Will you be a little easier?
We would actually chase them more. The frequency will be slightly higher. And by the way, when I say frequency means slightly higher, we reach out to these customers once a day.
Right.
In the pre-delinquency period.
Sure.
Post-delinquency, the maximum reach out is 2 times a day.
Right.
And the only exception is in the pre-delinquencies, the higher value customers will also get an IVR call because that has a higher probability of.
But is there a two-way response there? Press 1, press 2, whatever?
No, for us, we only take an indicator of whether it was picked up and heard for more than 10 seconds. And usually it's not 10 seconds, it's about 50% of the message. And we kind of try to cater our messages.
But that data comes back to your systems?
It flows back to WebEngage. And from WebEngage, that's how
we know that this guy heard the call, but he still didn't do anything about it.
Correct.
Versus the guy didn't even hear the call. So your journey will have a fork there.
Yes.
Awesome. So lots of variables at play, but this seems like a reasonably sophisticated system while you still think it's a 1 on 10. But the next part I would love to delve a little into is personalization. So there is, of course, the content of the message, which is first name, the loan value, due date, all that is standard personalization. So it's pretty obvious in your scenario. Is there more to it in terms of how your messaging style plays, like aggressive tone versus non-aggressive tone, language you already mentioned? Is there anything else you play around?
No, I think the aggressive tone versus non-aggressive tone and all the kinds of messages that we do. We know that certain types of customers, do value that their bureau scores don't get impacted.
Sure.
And the bureau scores getting impacted is not something that we can choose that, because you're not paying we will reduce your bureau scores.
Right.
All we are supposed to do is just report your loan to the bureaus and they will calculate your bureau score. But what we want to do is to educate the customer that, hey, if you don't pay it, it's quite likely that your bureau scores will get impacted and you might not be able to take loans in the future. So for certain set of customers, that becomes an important reminder that.
But at what point into which customers do you use this?
So there is basically, again, there are a set of these campaigns that we do for the customers who are beyond 10 days of EMI repayment. That's where it starts really hitting their
delinquency is slightly later, mature stage. Okay. So my angle was, this is again part of the journey and a certain stage. When I was trying to talk about personalization, I would talk in the same vein as it's a variable, right? The first name is a variable that's getting plugged into the message. Okay. The due date is a variable getting plugged into the message.
Right.
The language choice, I don't know if you do this at a splitting the campaign level or a personalized content level. You could do it both ways, by the way. But are you doing anything more on that side?
Let me try to think very quickly on if you're doing anything else.
I mean, yours is anyway highly customized.
Right.
But
no, I think this is currently the level of customization, which is where I believe... so we do some customization, by the way, is when the customer has paid. We also have a specific message for the customers who've paid.
And paid how early, this is how late.
And so in that message, we use a special string that there is another loan waiting for you. Click on this link. And that link instantly takes them to their loan. And that loan is already personalized because we've seen their repayment behavior and everything. With certain set of customers, we know we can't offer them another loan because they've paid too late for us to offer them another loan, so that link doesn't go in.
Right.
But one of the levels of customers you can do is as soon as you make a payment, we want to start.
So then this is like payment behavior segmentation as well, somewhere which will translate to what link is going.
Correct.
And how is this architected? I mean, is there like a set of universe of messages and a set of maps to users' calls?
No, so we've actually just put the link as a variable.
Right.
And the link is either there or not there.
Achha.
And the link for us is actually a hard-coded link which just takes you back to the Kissht app or the Ring app.
Right. And your app is where your personalization is.
As soon as you get on the home screen, you will see an offer that's one waiting for you.
Interesting. And, so personalization, taking one step, back and close home to the application experience itself. Is there, I'm assuming from a loan eligibility, what is the value that you're available for? Is anyways a personalized piece of info.
Correct.
But is there more to the user's first time, second time, third time, fourth time experience, which gets personalized basis whatever history, right? So the data points can get personalized, but would you show, let's say, different cars, different campaigns, different offers, different upsells?
Yeah. So one is, let me slightly switch to the Ring universe.
Sure.
That's where we're doing all of our personalization. Yeah. Kissht was less personalized. One of the big ideas with Ring was you're going to personalize it for every customer. So now what we're doing in Ring is our entire homepage is dynamic. We have a lot of campaign banners. The home screen is dominated by the products that we offer to you.
Sure.
Depending on the customer's set of transactions in the first billing cycle, we kind of give either prominence to bank transfer, which is taking money into a bank account,
right,
or give prominence to the card payment and scan and pay, or give prominence to bill payment, or give a lot of prominence to essentially rewards, because we know some customers are reward seekers. Now, all of this is personalized. And by the way, just putting a big caveat, in that also we are at level 1 of our personalization. We actually have a massive roadmap for specifically for personalization and engagement.
Right.
It's a 6-month agenda for us, right? Literally. And we've kind of just finished building the blocks, the fundamental blocks right now. The next 6-month roadmap for us is all about engagement and loyalty, rewards, and personalization.
So I would love to dig a little deeper on this, because it's something that we've developed, or let's say in the journey of developing as an offering, because while you have a large enough tech team and you can deploy all that bandwidth on making this happen, a lot of people don't. But we're very big fans of personalizing the user experience pretty much from the first day itself.
Right.
And you have all of these data points. You mentioned about reward seeking versus bank transfers, and they are different things that are important at different life stages. But on the day 0, just post KYC, also you have a bunch of those demographic information.
Absolutely.
Right. So if you were to just change the, let's say, the good morning word or good afternoon word on the main tile on the home screen to the language of the user where he's coming from. Very simple kind of stuff, right? Technically, this might need you to either work your backend or you could use our backend to make it happen. But is this something that, and this is just language I'm talking about, basis geography, where there's so many other demographics, the age brackets. If it's a 19-year-old versus a 27-year-old, there might be difference in the kind of things they care about versus not care about. So this whole data-led personalization or experimentation with different, let's say, elements of the user interface. I hear you that there is a degree of attention to the subject, and there's a lot more.
Massive. In fact, you harped on a very, very important point. When we started Ring, the whole purpose of starting Ring was the idea that we want to bring all of the products into one platform.
Right.
Credit, payment, all shapes and form of credit, all shapes and form of payment in one platform. But you can't do it in the Paytm format that everything is there on one home screen.
Massively.
Nobody's going to use it.
Correct.
Every customer is a different user. There are customers of say one card in the uni who want to use a card, who want the card experience. For them, bank transfer is almost unimportant.
Right.
There are customers who are heavy users of scan and pay, so you want to surface scan and pay at the very, very top, give all prominence to that. Just the color scheme different for rural customers and urban customers. The affluent people like a dark mode.
Right.
The not so affluent people like a light mode. So that all of those customizations you can do, and they will really have an impact.
Absolutely.
Once you're trying to keep your customer engaged for a longer period of time, his comfort level with your app will also probably be a big factor in driving that. If at a lot of levels the offering is commoditized,
right?
UPI is an offering that is commoditized. Everyone's offering the same thing.
Sure.
We are adding UPI to our app as well. We want to bring a differentiation. We want to tell him that, if you're using my app for credit, also use me for UPI, and please, you don't need to use the other UPI apps. We are a one-stop shop for you.
So I can imagine this will become your, let's say, central hook to do all sorts of cross-sells and upsells, as long as you're able to keep the user hooked in the first step. And that's why my question was that, and I'll bring you an example from the gaming industry. People who come from a certain set of channels and do a certain behavior in their first instance tend to have the highest non-repeat, highest bounce rate. Let's just say they'll exit the app and never come back.
Right.
Now, if you were to, in their first instance itself, throw a pop-up and say that, I'm loading this X amount of money in your wallet, continue playing.
Right.
Imagine the incremental delta that will come from
Oh,
you.
absolutely.
And every single day you have new customers coming in and who will go through this slight nudge, which is on a test and control level, you can measure what kind of delta you're able to bring in. And it's insane. You're able to drive uplifts in consumer behavior with a bit of a predictive model on the first day of the install itself.
Right.
So if you were to even look at that 60% number, I would be curious what percent of people are coming back to the application versus not even coming back.
Right.
Those who've come back, how well personalized is their experience on the first screen itself? And I would love to understand that a little more.
No, by the way, the point you're raising is very important. And that is one of the things that we want to get to very, very quickly. The
Right.
first app open after
Right.
you've done your registration and onboarding, when you come to the app home screen, depending on what you see there, you're going to immediately form a perception of the app. Right?
Absolutely.
If you're a customer who's likely to use a card and we've shown you bank transfer, you'll say, "Arey, yeah, this is a loan app. I don't want a loan app."
Absolutely.
Versus a customer who wants to do UPI and you show him a card, he's like, "I'm never going to use a card. Card is not my use case."
Correct.
That is the level of percentage we are working towards, and it's not an easy nut to crack.
Really?
It's
I'm sure.
From a perspective of business prioritization, it takes very, very low in our prioritization. We've spent the last, it's been since last September, we've now spent close to a year and a half on the product, of which at least the last 9 months have been full-fledged. The entire team has been working on the Ring platform. We've only put the building blocks in place.
Sure.
We've not even come to the finesse of the product. The polish of the product is the next to this thing. We have to bring engagement and loyalty first, and after that will be personalization.
So I'm not here to sell, I'm here to learn. You might want to experiment with the catalog and recommendations as well as in-app personalization components.
I am actually going to do that immediately because the only reason we pushed it out, by the way, is because we've always thought of this personalization being a very, very difficult problem to crack.
So
the engineering required for
please.
Just the engineering for it is something that I've not been able to wrap my head around. How do we make it granular enough, but at the same time, easy to manage? It can't be that you have 100 chords and 100 ko manage karna. The complexity of even the product design for the engineering aspect of it is complex.
Sure.
And you need someone who's done it, for a living to come and bring you that. You need a subject matter expert to bring it to you. Which is why when you're saying that WebEngage already has something for that, I mean, I'd be very, very keen to explore
Absolutely. So the reason I say that is because the moment you put the tech together, you'll also need some sort of a mechanism for the marketer or the growth PMO, whichever your team is, to actually play around, right? I want to do this experiment, this bucket gets this guy gets this.
Right.
And there are insane number of permutations that can happen, right? Because segmentation variables are available.
Right.
Now, people from Mumbai versus people from Delhi, you want to do different things? Sure, by all means.
Right.
So it's a playground. You want to make it available to your let's say product manager or whoever's the guy looking at this, and that's what we would love to enable. Anyhow, back to it. So aspiration wise, you mentioned that this is all there and you want to get there, and this is coming from a conviction that this is valuable from an incremental impact on business.
Yes, it will have a massive impact on the long-term value of the customer, and essentially that's the core of your play. And the 90 to 60 is where I'm the 90 to 60, the first to second transaction, the jump from, let's say, 100 people to 60 people is where your biggest focus essentially is, and the compounding effect comes from there, right? And you mentioned the whole value of the company. So, one of the things we believe very strongly in as a culture, WebEngage is an 11-year-old company, in case you didn't know. Right.
So we built very sustainably, somewhat profitably, never been very, very deep on our burns. And I love how you've been thinking about this whole CAC topic as well. So we also feel that thinking thoroughly about your retention and equation in early days is very critical for your long-term viability itself.
Right.
If you don't track these metrics and don't do enough about them in their early journey itself, you'll likely have a slightly harder time. And last year was a funding boom, couple of years maybe more, but this year is not. So if your business is going to be susceptible to these cycles, then you will likely have a hard time at some point or other. So we very strongly relate the idea of good user retention with good sustainable business practices. And that's very, very strongly knit up for us. And I see that, in practice happening here because you're very cognizant of each of these topics to be thought through. And does it have to do with the fact that this is the third startup you're doing or this is the second startup you're doing?
No.
Also the journey of the last 7 years.
It's more of the DNA of all of the founders. We've always so first of all, I think we are exactly like you. For us, we've never been in the business of burn and then we'll grow and then figure out how to make money.
Right.
One is in the lending industry, by definition, you can't be thinking of a model where you burn and then grow and then try to figure out how to manage these customers. In lending, you have to make money. I mean, that's the whole nature of the business. in lending, if you're losing money on every loan you're doing something incredibly criminal. That's the way we've seen it.
I wouldn't be surprised if half the audience or half of your competitors are still doing that, right? Because all that money getting...
Yeah, see, everyone again has different motivations and different strategies. And that's where the founder DNA comes in. Our DNA has always been very, very strongly that either you are already making money or you have a very, very precise roadmap to the place where you make money. Every customer we acquire this month, we are going to lose money on him for the next 3 months. But we know for a fact that fourth month we are going to recover at a cohort level.
Sure.
We have never done businesses where we knew the outcome was losing money. We might have lost money because of some unintended, unforeseen circumstances. But we never go down a path, oh, let's do this because it's going to get us scale. We get us a lot of customers and then we'll figure out what to do with this base. We'll cross-sell, upsell. No, that's not how we think of it. But that's more to do with all of our DNAs aligned. We've been very intent on saying that we want to create a valuable franchise. We want to create a long-term sustainable company. Almost every fundraise we've done, that's been to grow either newer channels or newer models. But never to say that, oh, we want money because we've burned or blown through the last set of money and we now need more money to acquire more customers to keep going.
So this is the business that will IPO in what, X number of years? You have eyes set already?
We haven't set a date as such. We at least internally we are a minimum of 3 years away from an IPO. With lending, you need to be a certain size of the book
to be meaningful.
And we are not there yet. And
this is a journey, the way it looks like it.
The good part is we are profitable. We are growing very healthily. We are getting a lot of debt from the market to grow. So our growth is not getting curtailed by
because of your own books.
Access to capital. So we are in a good spot, and we'll plan to go public when the time is right.
Awesome. You know, this would be towards the end of last part of my conversation. So I'm just going to bother you with some data-related topics. Just at a super macro level, on this whole user data, dashboard engagement, some of these metrics, what are the key KPIs that you at your level care about on a daily basis?
Be slightly transparent again. The biggest KPI for us is the default rates.
Default rates, sure.
Because that's one of the most important.
And you said this 10 days after the due date.
No, so for us, the default rate is, there are two specific numbers we look at. We look at the T-day bounce rate, which is how many people did not pay on the due date.
Sure.
Which number is usually in the 80 to 82% range, because again, voluntary payment. So about a good 20% pay after the due date.
Okay.
But it immediately tapers down. And what we look at is the T plus 10-day number, which is how many customers haven't paid out that, because the T plus 10-day number is a very strong indicator of where you're heading. That's one of the.
And is that in line with your predictions or not?
Yes, in line with
usually it's to 1 decimal, it's in line.
Correct. It's usually supposed to be, but there are always some trends that surprise us. Even as simple
this is an everyday morning thing.
It's an everyday morning thing.
Discipline to that level.
By the way, it brings out a lot of trends.
Of course,
so TDA number not being in line generally always is an indicator there was a payment in UPI yesterday. So there are many of these outages that affect UPI at an industry level.
Technical, operational, several topics, but it also goes back to what kind of customers did you acquire. It has bearings on a lot of things.
Yes.
So that's one.
All of a sudden, the number looks better than it's supposed to be. And I just immediately check with the analytics team, and that will mean that, okay, exactly 30 days ago, they launched the new model.
Correct.
And that has already, if I'm positively surprised, the first call is to the analytics team. If I'm negatively surprised, the first call is to the payments team that did something go wrong with the payment setup. That's one of the most important number we look at. The number two is the number of new customers acquired every day. That is because we are actually in a phase of the company where that growth number is super important, because that's going to build the funnel for almost all the products that we're building in the future.
This is installs or first transactions?
These are first transactions. Okay. So the bottom of the funnel for new customers acquiring each day. The other set of metrics that at least we've been keenly looking at right now is how many new merchants we've acquired. What is the efficacy of the sales team? One of the things that is...
Down the org, of course, there are several metrics, I'm sure, that are being enabled. I was curious at your level and your
So at my level, the one is default, the other is new customer acquisition, the third is number of new merchants acquired, and the fourth one that we started tracking very closely right now is number of customer escalations. How many people call the call center, how many were missed calls, how many missed calls were returned.
So that's an indicator of customer experience in some sense.
Yes, and for us, what has happened is because of a lot of changes that have happened because of regulations, we've had to turn a few products off and all of that.
The prepaid card thing.
And we had to move customers from one product to the other product, and all of a sudden they were slightly shaken. And this is happening right at the time where we're trying to build a positive brand experience.
Right.
So it's become a very, very important metric for us that, okay, the customers, we know the customers are dissatisfied. What's the quantum, and are there any things that we can learn from this customer that we can offer them as an interim stopgap?
Right.
So we're kind of bringing all the products back now in partnership with all of our banking partners, but with the blessing of RBI and NPCI.
Sure.
But while we do that, the customers have been disgruntled.
It is a bit of a journey.
Yeah. So we have been very, very closely paying attention to what is irking the customer, and are there any interim stopgaps you can do. It's difficult to have a customer base that was loving your product. All of a sudden, you tell them that, oh, the reason you were loving a product is gone. Please take this temporary product as a replacement while we go and fix things for you. And that's
but that's the truth of the whole industry, right? That
everyone, yes,
everybody kind of thought they would get away with it, but somehow they couldn't. But RBI has taken a very, very strong stance as well.
Right.
Okay, so this is the daily thing. What happens, and who owns this whole 1 to 2 thing in your org, and how's that team?
So the 1 to 2 thing in our org is own, and so one of the things I think we covered only partly is we have essentially 2 analytics team. One is the risk and business analytics team that is largely looking at the risk models, the performance, and all of that. We do have a separate team, which is the product analytics team. The product analytics team is the team that is largely looking at mix panel, seeing the flows, how much time the customer is spending, how many clicks is he doing, all of that. So both of these operate very, very independently. The product analyst team rolls up.
Their own KPI and conversion funnels.
Correct. And on a day-to-day basis, the largest numbers we look at are the business numbers. What we look at on a longer-term view are the funnels, how many customers are getting retained. If they're getting retained, how they're changing their patterns on what product they were using in the beginning, what product they're using towards the end. Whether their intensity of transactions is reducing. As soon as we see a trend of reducing intensity of transactions, this is a customer on his orbit out.
Yeah.
And those are the things that the product analytics team at least trying to maximize.
So would this be owned by product analytics? The first loan to second loan journey, the 60% number that you really want to make sure you're getting attention to?
So the first to second, we are, at least the thesis, by the way, for us right now is more of a pricing issue rather than a product issue. But one way to put it is actually both of them are trying to solve it independently. We don't know which.
So the risk team ends up giving you the price bracket as to what kind of price at which you can give him the loan.
What is the cashback we can give him? What are the incentives?
How do you incentivize or excite him or whatever? And the actual execution for this whole thing is, I'm assuming, is there a technically automated system where they put in the score and then that comes back to the surface and manifests itself into
so the pricing change model, where from the first cycle to the second cycle, second to third, if you want to ever change the prices, it's a completely automated system. Where just the analytics team has to say that this is the flow that has to be followed. If the customer is in his first cycle, has paid on time, in the next cycle his interest rate should drop by 3%. His limit should increase by 100%.
I find it very interesting is the room to experiment and play around with stuff where this team and this team end up working in sync. And I'm going to show this guy these 3 things. Let's see if he responds better to this one or not. And then we can kind of take a call on
one of the things that I think we've not been able to do very easily is this kind of an A/B testing on the pricing. That's more to do with operational bandwidth that we've had.
Funny. The same thing that I told you might solve for that, might solve for this as well. So we have some stuff to follow up on.
Yeah, so we certainly do. A/B testing has actually been one of those, A/B testing on pricing has been one of those things that at least I have been clamoring about.
You'd love to do, right?
I'd love to do.
So much more power in your hands.
Yeah, but we struggle because, it's one is to actually do the A/B testing, but then we already have difficulty enough to decipher some of the output from customer behavior. It's not that easy, right? It's not that,
so even the product team has its own thousands of tests going on, I'm sure. They have their own plays. But those are the most critical, let's say, business implications. The score, the kind of limit and the kind of value you're able to give to that guy. That might end up being a big determinant of whether he moves to the second or not, in some sense.
Even with the 30-member analytics team, we have such a massive backlog that something like this has not been prioritized
I can imagine. So now stepping back for a moment, since you mentioned you're still on day 1 of your journey on personalization and user engagement, what is your idea of a Nirvana picture?
To be honest, from a product perspective, I think what we've built in Ring is one of the things that I always thought was a very, very good product for India. UPI, credit card, credit on UPI and bill payment, transfer to friend, transfer to bank account, all of it in one place, but presented in an interface which is super, super customized, very, very meaningful to use. Literally, the thing on the surface should be the one that you're most likely to use.
Which by default does use personalization,
right? and trying to be able to offer the right pricing to the customer. Ultimately, again, harping back to the same point, you have to be profitable.
Right.
Can't offer just UPI, and even the cost of running
It's a
servers
business.
for UPI is insane.
It's
that
insane. Yeah.
that you can't do it sustainably. But in India, there are pockets of customers who you will have to service at 0 rupees. There are customers who will pay you 10 rupees for every 1,000 rupees you lend them. There will be customers who pay you 30 rupees because those are the market forces acting in that way. You could always have a product that is used universally by all segments of India. You are profitable at a entire customer base or a company level.
And you still have a headroom to grow massively.
And you have a headroom to grow, and you can have a product that essentially you can advertise to everyone. You can essentially do a TVC, and everyone who sees this will find the product
something
relevant.
or the other. Because the moment they've installed the application, you know enough about them to do whatever you want to do.
Correct. And that's what the holy grail for us is. I think we are well along the way. Personalization for us is a mystery. Getting this pricing absolutely bang on correct is going to be a challenge.
World journey.
Even the fringes, you want to get it right.
Of course.
Because all of a sudden, at the scale at which we are imagining,
the fringes
even the
a million
smallest
people.
delta will add or subtract 1 million people. Those people become detractors to your product, have a cyclic effect.
Yeah.
On the other side, they could have become promoters for your product, and you could have had a virtuous cycle. So that's essentially what we are looking for.
Very interesting. So how do you keep the energies high? It's a long journey you've already been on, and it seems like you're here to stay for a fair bit of time. You're talking about an IPO and not to selling out to a Paytm or whatever, which is great to know. How do you keep the energies high?
And so I think the energy has automatically been high because of one is in a good way or a bad way, RBI has kept us on our toes.
Of course.
But no, the challenge of working on an exciting product has not only kept me and the other founders super energetic, but the team is automatically motivated. You are throwing new problems to them to solve every day. And I think that is what they love.
Sure.
What has also happened is while the scale has kept growing, all of a sudden you are solving the same problem that you were solving last year, but at a completely different scale. With a completely different expectation of responses and results. And that is what keeps the team excited. One of the big wins for me is the attrition of the tech and product team is incredibly low. I was solving scalability problem when we were going from 100 loans a day to 1,000 loans a day.
Right.
And now I'm solving scalability problems of going from 10,000 loans a day to 1 lakh loans a day.
Right.
Same problem, completely different solutions. And that's what keeps you excited. I think it
keeps you growing.
Uncovering a different layer of the onion. And that keeps you excited.
Very interesting.
Product problems are some things that I think all of us love to solve. The founders, the engineering team, the product team, all of a sudden you tell them that, see, the only problem is customers are not going from cycle 1 to cycle 2. Everyone has a different interpretation how to solve the problem. And I think everyone is chasing that in different ways. Some say that, if I just increase the speed of the interactions, people will be happy about the app and they'll stay for longer. That's what the engineering team thinks.
Hypothesis one. Sure.
Yeah. Product teams think that, personalization is missing. We need to give right experiences to the customer for them to stay back. We need to compete with Google and PhonePe in the experience part of it.
Right.
And the engagement and loyalty team says, we need to have all the features that Cred has. Give them rewards, give them spin the wheel, give them coupons, they will stay back. At some level, we are actually trying to throw everything at the wall to get that 60 to increase, but with the right level of prioritization.
Awesome. So when was the last time the data team actually threw some information at you which actually amused you?
That was an interesting question. Let me think about that for a moment.
It happens to us all the time.
Very recently, and again, this is a data point that's again circulated back to us. A good 7 or 8% of our customers are CIBIL 800 plus and have a credit card already. And these are customers who are the late repeat customers who are using our app often. And they are paying a transaction fee of about 1.5%. So they have a credit card that they could always use. They have a good CIBIL score. They could have gotten to an HDFC or SBI. They would have had a lazy pay account or a simple account as well. All of a sudden, we were wondering why are these customers using us? And we did a sample set of the customers. And they said that, I go to the Kirana wala has a ring, this thing. Almost any other way to pay is complicated. And he says that I use about 1,700 rupees a month. The number that I have to pay you comes to 30, 40 rupees.
Who cares?
Who cares? Like, for the convenience, I pay that because I sometimes I don't have money in my bank account and I don't have money in my wallet. Just good CIBIL doesn't mean that you are,
always
staying on a savings account. He's like, sometimes at the end of the month, I run out of money and my Kirana has a ring sticker, so I use it. I'm like, okay, This is the power of transactional credit. If you're present at this place where the customer needs credit, all of a sudden, all the other rule books go out of the window.
7% of your audience.
Yes.
This is an entirely amazing opportunity to unlock, right?
Very surprising. And for us, this just speaks loudly against every single rule of credit.
Which is very interesting.
A customer who already has access to credit has actually gone to another platform which is significantly worse for him and uses it for convenience. We truly believe, and one of the theses with Ring is convenience is going to bridge a lot of these divides. Our cost of fund difference, the one that we struggle with right now, can be bridged at least to a certain extent if we do, basically personalization well, convenience. It has to be a very, very efficient product. Just the experience might solve for some of the cost of funds gap that we experience against larger lenders.
All right, so I come to my final question. Aside of farming and flying drones, how do you recharge your own batteries?
So I think for me, for a very long time now, for the last couple of years, I think farming has become a way to recharge my batteries.
It's every weekend there now?
It used to be every weekend when we were working from home. Now it's actually become about once a month. All of a sudden, after COVID has lifted, all the social commitments are back in play. Yeah. You have to attend a wedding, a baby shower, a birthday, a baby's birthday, and all of that shebang. So that's actually what's taking up the weekends. But besides that, it's all the vanilla items. I love to travel, so I try to get out of Bombay as frequently as possible. But I think the best way for me to recharge has become farming. There is a different joy in life to
create and watch it patiently grow.
Patiently grow. Yeah, and the greenery, the aspect of just fresh air, lots of greenery, no concrete around you is a recharge by itself.
Awesome. Thank you so much, Karan. This has been a very, very interesting conversation. I have learned quite a bit about the state of retention marketing, at least at Kissht and Ring. I'm sure there's a lot other organizations have to learn and pick up from their playbook. We hope to do more of this. Thank you so much, Karan.
Thank you so much, Ankur.